average Joe, regular Joe. I forget his goddamn name, but he went from being a dividend focus type of investing channel, which I used to watch. I didn't care for his spreadsheets too much. I hate spreadsheets. I think they're fucking pointless, to be perfectly honest, because you can literally just use a free dividend tracker, use the free version of a dividend tracker to track your dividend income or whatever you want to do. Just look at your broker. Or I use stock analysis app and I just look at total returns and shit like that. There's other things I use too, like dividendchannel.com and totalrealreturns.com to look at total return over time and performance year after year. And that's how I track my dividend income and the performance of the funds I invest in. Anyway, let's get to the point. This guy switched from being a dividend channel to an option channel, and he's like really back testing on spreadsheets the success rate, the win rate on spreads, like vertical spreads, like selling, like for example, put credit spreads. And the thing is, he just started recently in the last couple of months talking about this shit, and I don't think he has a clue about the risk that's involved with doing something like that in that fashion. Yeah, you have a 70% back tested success rate. Problem is, you sell the spread, and you can literally get like maybe 20 cents on the dollar at the most. Maybe not even that. Like you could have a vertical put spread that's five apart, which means you're $500 of leverage on a spread that probably only pays you 20 to 30 bucks, for example. So your max loss is that 500 gap. Let's say you got a 180 and a 185 strike or whatever it is, like for in the case of Amazon or something, you're leveraging $500 on that spread because that's your max loss minus the premium you receive. So let's say you receive $30 in premium, your max loss is going to be 430. Problem is, critical fact, and these are my comments right here to this guy. He's missing one critical fact. Spreads can be active even after expiration, after close of business, because basically, like especially on indexes or like I believe in on SPY and Triple Q, which in this particular video, this is what Joe's talking about, Triple Q options. They could still be active. There was a kid that was trading an account on Robinhood some years ago, and he had multiple contracts, multiple spreads that he didn't manage well, and on the day of expiration, he was still slightly out of the money. And back then, Robinhood didn't protect you by automatically closing closing out your spreads if they were close to being in the money. So what happened is after expiration, SPY options were still trading. He got a sign on all those contracts, but because he wasn't paying attention over the weekend, his protective put that he bought didn't protect him from the downside or, to cap out the downside. And so essentially what happened was he got assigned all those shares because they exercised the sold puts basically, but he didn't have the money. And so he thought he was going to be owing, I forget what the amount was, but it was a massive amount. So he panicked basically and ended up, taking his own life, unfortunately. So that's the risk to spreads. You're risking pennies before a freight train. And so this guy's switching to like options and pushing out these spreadsheets that calculate success rate, aren't pointing out the fact that you're risking basically hundreds of dollars to make 20, 30 bucks maybe on a spread. I can show you what I'm talking about. Let's go to Webull, for example. Where are we at? That one already pulled up. So look at the top part of this where I'm buying one Amazon 150 strike put as my downside protection. I'm way out of the money on it though on this one. I can edit that out. Let's go to 165 basically. So we're closer. Hit done. So now I'm going to buy the 165 strike for my downside protection. And for a credit, I'm selling the 170 because I'm going to receive more premium on the 170. You enter in this trade at the same time. Now your risk is the gap between the two strikes minus the premium received. So in this case, the midway point on these is 18 for the one you're buying and 27 for the one you're selling, for a total premium receive of $9. This has got an expiration date of February 27th. So basically just a few weeks out, 2 weeks out maybe. And you're only receiving $9. So you're leveraging 500 bucks. You're only making $9. So you take that 500 minus 9, and so you're risking max loss of $491. That's not a good risk to reward when you're doing options. That's why I hate spreads. I used to do spreads through 2021, 2022, and I had great success with them. But what happened was I got caught. And when I got caught, I eradicated all the success I had with them just with a few of the trades. They were so upside down. I closed for massive losses. And the thing is, like I said, the amount of money you can lose on a spread is much more than what you will gain. The risk reward on that is horrible. That's why I don't like spreads. If I want to own a stock outright, I make sure I have the money to own it. Like in the case of Amazon, I'm not going to do a spread. I'm going to sell the put if I want to own it, and I'm not afraid of owning it at 170. But I'm going to make sure I have a 17,000 on the sideline to own it. The other risk to this is if it expires and the option is still active, you're assigned on the spread that you on the short position, the one that you sold. You get assigned the shares, and if you don't exercise your bought put option, you got no downside protection. That's what happened to the kid I was referring to that used to trade on Robinhood a couple of years ago. And Robinhood now, what they do is they'll close even prior to expiration any spreads that are close to being in the money. They'll do that because of how much bad press they got out of that situation with the kid that unfortunately had taken his own life. So this is why I lost all respect for regular Joe guy, and I won't even mention his name anymore. And I think he's pumping this stuff on spreadsheets, and too many people are like, oh, fascinated by conducting a spreadsheet. And I really don't need to do that because I know what I want to own. And basically, I just track things on their performance. I can look on their price performance. Like, for example, I'm looking at chat right now on a max time frame. 145% in price action alone, Of course, this ain't a dividend payer, really. It's not known for that. But if you're going to take a dividend one, like I'm all about dividends. So let's take, like, for example, BizD, which is a exchange traded fund for business development companies. And let's look at the price action. Now, if you look at that price action just on a share price in the max time frame, it's down 31.62%. Okay, I don't really like that. So on the 1 year, down 20%. Year to date, it's down 2.68%. So it's got NAV erosion, right? Now we want to see what we do on total return. On total return, you're going to get a different story because you're getting dividend income. So they're looking at negative 10% for the year. That's sad. You're only up 26% for 3 years. That's less than 10%. I want a better return than that, and then I want that kind of NAV erosion. So I want to compare it to a different type of exchange traded fund that I might be wanting to buy. And anybody can do this on stockanalysis.com. Of course, you got to pay for the subscription, basically. So SPY, I think it's been around at least 3 years. It looks like it has. It's really outperformed BizD. Look at that return. It's more than double the return. And so which one am I going to choose as a fund I want to go with? Well, okay, let's decide I want SPY. But I want to see the price action too as far as how the net asset value holds up over time. Let's go on the max time frame for its history. It's up almost 6% on price. Go on the 1 year because they hadn't been around 5 years. On the 1 year, it's up 2.5% on price. And this is something paying like a 12% yield. And it's amazing that it's up on price. Of course, the market's been in a bull run. It's not going to last forever. Trust me. Now we can check the total return just on itself. So the total return on this since inception, and this thing, just go max. That give you the inception. Total return on it with dividends reinvested, basically 62.56%. That's something I'd be interested in holding. That's how I test the fund. And I'm not doing spreads on anything. I'm not doing any kind of vertical put spreads or vertical call spreads. I avoid those. If I have like shares of something that I don't mind taking profit on, I sell covered calls. That's what I do, especially if they're overbought, like they're extremely over the RS, 70 to 80 RSI, for example. I'll sell them. What do I mean by that? I don't know if you guys are following me, but let's, for example, let's go to Amazon's chart, for example. Would I sell a covered call on Amazon right now if I owned 100 shares? No. And it depends on my cost basis too, but no, not in particular, because look at that. It's way oversold. It's really beaten down. Bad time to sell a covered call. You're not going to get much in premium depending on what you want to ever, whatever you got assigned at if you ever was traded in the past or something. You could have a great cost basis. I would do it at a time when, looking at the RSI, which is right down here, right? At a time when it was extremely overbought, breaking RSI 70. Let's go back. And see, most of the time when it hits 70, it's going to pull back or dip a little bit. It rarely, I don't see anywhere where it got above 70 in the past year or so. But so if I wanted to make some money on Amazon, I would wait to above 70 and looking for RSI divergence. Basically, RSI starting to slope downward potentially. Then I'd consider right in here selling. Let's see if I can show you. See right in there where the RSI is starting to slope down. It's flattening out and starting to slope down. I would have sold a covered call right up in there, and then you would have had some downside in here, and you could have taken profit on your covered call at some point. That's how I would sell a covered call. But on a growth stock like Amazon, I'm buying it for the long haul. Why the fuck would I want to sell covered calls on it? I want that upside. So I'm not going to sell a covered call on it. I'm going to do the complete opposite. If I want to own Amazon, I'm going to sell puts when it's deeply oversold like it is right in here. Look at that. RSI below 30. Yeah, I got to like Amazon in the long term in order to hold it, right? Because there might be more downside. That's a bearish chart, obviously. And it could be more downside. But in a long haul, my belief is Amazon's going to go up. So if I want the shares, I could get them for a discount. Maybe I'll sell a put, at the 200 strike. And you can see what you get on the money on that too. But anyway, I digress. That's the only way I trade anything in life. Yeah, I mean, in the market, in life too, actually. I go long for things that actually got a growth catalyst in the future to expand their business with either AI or their cloud or whatever, like in the case of Amazon, or if they're paying a dividend, like in the case of SPY Eye, and they've got a great, beautiful track record, like I just showed you previously on SPY Eye. That's when I'll consider maybe doing options on something. Like in the case of SPY, I'm just buying that outright. I'm not really trading options all that often. On occasionally I do, but the reality is, when I get a discount on SPY because it pays that yield, I'm just a buyer, nothing more. And I only sell covered calls on my shares, even though I'm way up, right? And it's kind of topping out lately. It was getting a 52-week high on it, and I could have sold covered calls, but I don't want to lose my shares. I'm in it for the long haul, and my cost basis on SPY is way under 50, so I'm not going to sell covered calls and just take profit because I'm going to lose that dividend income. So, the only time I consider it is like maybe on red days I might sell a put on it or something like that if I think it's going to bounce and I can take profit on the put, or I want to be assigned at a cheaper cost basis. Anyway, so I avoid spreads like they're the plague, and that's what I think most people should do because they can really destroy your account. All right, guys, and I'm speaking from practical experience. It happened to me back in 2022. All right, guys, take care.